We just got some enormous news on the housing market, and I'm excited to share this with you. Bill Pulte, who is the regulator of Fannie and Freddie, the two housing agencies that do conventional loans, just announced that he's allowing them to begin to use the VantageScore scoring model. This is a big change and opens up the funnel to many more buyers, and I want to take a moment to show you how. So key bullet point number 1, Fannie and Freddie now officially accepting VantageScore 4.0. First time an alternative FICO is approved for conventional mortgage loans. That's a big deal. And here's why. VantageScore 4.0 includes rent, utilities, and telecom payments as part of their credit scoring model. And it allows consumers with as little as 1 month of credit versus FICO requires 6 months to actually have a score and qualify. And it uses trending credit data to assess behavior over time, not just a snapshot. That's another big deal. It's expected to make up to 40 million more Americans scorable for a mortgage qualification. That is huge news right there. It drives greater financial inclusion for renters, first-time homebuyers, and credit-invisible populations. I mean, I have clients right now that are in that right now. It's just, we're getting them a loan, but it's hard, And then it may reduce costs. It's going to reduce costs for lenders and borrowers because there'll be some competition in the credit scores. And then it allows consumer advocates and regulators greater fairness. And FICO stocks actually dropped yesterday. So anyways, so here's the thing. FICO had a complete and total monopoly on the credit scoring system that was used for mortgage lending. And as a result, they've been increasing their fees. Credit reports used to be literally $20, and it was $49. Now it's $199. It's something crazy to do a credit report. So the reporting fees, and these are end up getting passed along to the consumer by all the lenders. So it'll drop the fees. But the biggest thing is it allows somebody I have borrowers all the time, and this is so typical that maybe they pay rent on time. So the idea is, hey, if you can pay your rent and you pay that on time, you're probably going to pay your mortgage. So they take that into consideration. They take into consideration, hey, do you have some utility bills? Do you have your telephone? Do you have your insurance? Those kind of things. Because right now, I'll pull a credit report sometimes and I'll see very limited maybe consumer history for FICO model, but it'll list, self-reported telecom, self-reported this. It shows all of their bills, but the FICO doesn't pick that up in their scoring model. This one will. And for anybody out there that has ever tried to get a mortgage and had your credit pulled, and you're looking at your Credit Karma or Experian or any of the scoring models from your credit cards, and say your score is saying it's 700, and then the mortgage score, you go to a mortgage lender and they pull it and they say, it's only 580 or something like that. It's way lower. That's because they're two different scoring models. This is the exact reason. So taking this more consumer-friendly model into mortgage lending is going to have a huge impact. It hasn't rolled out officially. They have to put it in their system, so we don't know on a practical level what it means. We just know what the opportunity is. It's like a funnel a big funnel that's got to open to all these borrowers. So if you've been sitting on the sidelines, or you have family or friends been sitting on the sidelines that wanted to buy and their credit just wasn't quite high enough, let me know, connect them to me, send me their name, cell, and email. I will build them a great mortgage plan. And as soon as this rolls out, we'll see what it will mean to them in terms of more advanced purchasing power, better loan, lower interest rates, and more opportunity to purchase home. So I hope you found this helpful, and I hope you have a great day.